going to give everyone about 1 more minute to join. Again, we just want to welcome you all on board to another exciting webinar. Like my colleague Eddie was saying, we're really excited for another fun topic. I know this is the spring season right now, and we all know that once the weather starts getting nicer, oftentimes that's kind of like a little motivator for those that that are a little bit on the fence about buying a home or refinancing. So that's one of the main reasons why we decided to to go ahead and do this fun webinar for you all. So just hang tight. We're gonna wait 30 more seconds to give everyone enough time to join us, and then I'll be doing the introduction of our panel for this evening, and we'll get started here in about 20 more seconds.
Shout outs to two of our own that are in this webinar this afternoon. Kimberly Friedley, we appreciate you for being here, and Miss Kelly Pasilio. Thank you for being here as well.
Hey, Kelly. Hey, Kim.
I'm sure they're waving their hand wherever they are, you know.
I'm sure they are.
Kelly, raise your hand.
Yes.
With that being said, it is 6:03, so we want to respect everyone's time. Let's go ahead and get started with the introductions. As a lot of you are already very familiar with. I don't think that they need an introduction, but I think it's a must. But I'm very happy to welcome again and introduce you all to our wonderful marketing team. With no particular order, but we do have Eddie Villanueva and Carrie Lazar. They will be joining us on this webinar. And just so you'll know, they're going to be assisting with the chat and the Q&A. That's something that I will highly encourage everyone to please utilize that. And something different, something new that we're doing today, actually, as we go with the presentation. If anyone has any questions that you want to ask in the middle of the presentation, please do so. There is an option there for you to raise your hand, or you can send a chat message that you have a question, and we will interrupt our presenter today. So please do not, you don't have to wait towards the end of the presentation like we normally do. So this is something new, but our presenter has encouraged all of you to ask your questions if anyone has questions in the middle of the presentation. So don't be shy if there's anything that you want to ask, especially once we move through some of this really great different phases when it comes to the home buying process. Please, we welcome you to ask your questions. If you want to just ask the question on via chat, or if you want us to allow you to come in and speak, we can do that as well. With that being said, as many of you know, my name is Milton, and I'm the Membership Development Officer. And I will be your MC for this evening. And please allow me to introduce you to our speaker. This person, she's been in the banking industry for a little over 20 years, believe it or not. She is a local. She received a bachelor's degrees from the University of Maryland in business management, and also has a dual master's degrees from Johns Hopkins University. Has been working in the DC area with different roles, whether it's with consumer lending, mortgages, small business lending, you name it. She has done it all. She's been with the credit union now for a little over 7 years. With that being said, please allow me to introduce you all to our senior mortgage loan officer, Kim Tao. She's going to be leading this presentation. So Kim, please take it away from me.
Thank you, Milton. That was wonderful introductions. Thank you so much. Hello, everybody. I am honored to be here to go through the home buying process with you. It is springtime, so it is a time to buy a home, look for a home, so that you all can move in before the fall or before the school starts. So we are doing the American Dream Home Buying Education Seminar today. Milton will do the slides for me because technology is super challenge for me. So I have asked Milton to help me out with the presentations. So Milton, next slides, please. Milton,
Yes, go ahead. Go ahead, Kim.
next slide, please. Can you change the slide for me?
You might just be having a little lag. We can all see it. How much can I afford? Cash funds required.
Yeah, can you see that?
I couldn't see, I don't have it on mine, so let me see. Let's see. All right, so I mean, I can go through it. What we're gonna go over today is how much can you afford? Cash funds required, pre-qualification versus pre-approval, shopping for home and loans, the closing, and some helpful reminders. Next slide, please. How much can you afford? Typically, I would say 2.5 up to 4 times your annual salary, annual gross salary. So if you're making $100,000 a year, 4 times that would be 400,000 would be your loan amount. So if you have 100,000 for down, you could get a loan for 400,000. So the price of the house that you should be looking at is around $500,000 range. Ideally, the lower the better. But in DC area, I would say anywhere from 4 to 5 times your salary. It's the maximum you should think about. Next slide, please. Spending guideline. You can see on here, this is a perfect picture of a household budget. You should not spend more than 35 to 36% in your housing, and that's including mortgage payment, taxes, insurance, condo or homeowner association fees. 25 is living expenses. 15 is for car gas, maintenance on your car and gas or metros and all that stuff. 15% of your debt would be such as student loan, car loans, credit cards whatsoever, and then 10% is your saving. Next slide, please. Cash funds required. What do you need in cash to purchase a home? There's 4 particular items I have is down payment. It should be around 3 to 20%. Ideally, 20% down payment would avoid PMI. PMI is private mortgage insurance. And if you don't have 20% down, you could certainly get into a home with 3% down, depending on which level of income you have. You can go up from, ideally we do 5 to 10%. 20% would be, like I said, it would avoid PMI. Anything less than 20% down will have private mortgage insurance. Earnest money deposit. However, earnest money deposit would be when you find a house, you want to put down a down payment to let the seller know that you are very serious about purchasing the home. So you have to put in some down payment, and that depends on your negotiations with the seller. Okay. Closing and settlement costs. This could varies among settlement company. The closing and settlement would include the rest of your down payment, and then the closing costs and settlement fees on there, and the bank's fees. So all be part of your closing costs, closing and settlement costs. And then you also want to have some reserve for some cosmetic home improvement once you moved in the house, and then to furnish up your homes. Next slide, please. What's your mortgage payment include? It would be your homeowner insurance, your property tax, and then your principal and interest is part of your mortgage payment. You also have to think about utility, furnishing a home, and also, just some kind of home improvement as well. Next slide, please. 4 qualifying ratios. What does that mean? So we have a front end ratio, and we also have a back end ratio. So the front end ratio would include your mortgage payment of principal and interest, your property tax, and your homeowner's insurance. Those are the front end. Those are just the housing ratios that's the lender calculate for you. And the back end ratio would include everything on the front end, which is the mortgage payment, and then along with your other debts or other obligations, such as your condo fee, your car key, your condo fees and HOA fees, your credit cards, your student loan, your auto loan. All of those are considered what we call back ratio. And the front ratio should not, ideally, the front ratio should be no more than 36% of your monthly gross income. And then the back ratio, we would not go above, you should not have more than, say, 40%. But we can also, with the area in DC, we do usually go up to 50% on the back ratios on that. Next slide, please. Pre-qualification versus pre-approval. We hear at, most of the time we hear at the US Senate, we do pre-qualification and pre-approval is practically the same. I would do the review of all the application, and then we will, you know, I will issue you a letter and commit that we can do this loan at this term. And the letter is good for 60 to 90 days but if you have that letter, you can start shopping for a house with a realtor. And like I said, the letter is good for 60 to 90 days, depending when I have to pull credit. After 90 days, I can do another letter. I just have to pull another.
Did we lose you, Kim?
I believe she's getting reconnected, Carrie. Hey, Kim, are you back? Are you back with us?
I'm back. Yes, I just saw it. I saw some blip. It went away for a little bit, and I just signed back. Can you hear me?
Yes, we hear you back.
Thank you. So the pre-approval would be like a formal commitment that we said that we will, you know, we will approve the loan based on the information that you had given us, and the letter is good for 60 to 90 days. And it's not pre-approval. It's not saying, it's not a guarantee that we will approve the loan. As long as everything stayed the same, you should be able to qualify for that particular loan. Milton, can you next slide, please? Couple of things that you need to remember for when you shopping for home is your budget. And on the budget, I would say, you know, keep in mind you have your mortgage payment, your car loans, your credit cards, and all of that. You just have to keep in mind how much you want to spend in terms of mortgage payment.
Hey, Kim.
Yeah.
I'm sorry, we have a question.
Okay.
If you don't mind, is an earnest money deposit refundable if the purchase transaction does not close?
That depends on the contract. You have a certain days that you have to decide whether you do want to buy this house or not. And if you decide to cancel within that certain time period, then the earnest deposit money can be returned to you. And if you, for some reason, you're not qualifying, you know, at the end, you put in the application for a loan and you don't qualify for the loan, sometimes that also has to be returned as well. It depends on the state and your contract on the contract, the sales contract. But that's something that the realtor can go over with you, and you can negotiate that with the seller, and you talk to the realtor about that.
Thanks, Kim.
Mm-hmm. Milton, can you go to the next slides where it's negotiating the deal? Next one. Shop home, next one.
Sorry. Okay. Okay. So this is, which slide you said again? I'm sorry.
Negotiating a deal, next. Next one. Next. Okay, so on here it's a negotiating a deal. What kind of things might you can negotiate during the purchase of your home? Next slide, please. There's 4 items that I can think of: the inspections, sell current home, appraisal, and closing costs. So the inspection would be, you can ask the seller to pay for the inspections. You can waive the inspections if you don't want to do the inspections of the home, but I would highly recommend that you don't waive the inspections, because that will let you know you have to inspect the house, and that the inspector will let you know what needed to be fixed. So I would recommend that you don't waive the inspections. Selling your current home, if you currently has a house and you needed the money to down payment, I would put it on the contract as a contingent to buying this house. You have to be able to sell your house first, and you can negotiate that. Or you can, if you could afford it, then you want to keep the house here, you keep the current home and then buy a new home, you can certainly waive the selling current home as a contingency as well. The appraisal process, you can waive it. I don't know if you can negotiate the seller to pay for that or not, but certainly you can negotiate for the seller to contribute some amount, a percentage or some amount of flat amount of money towards your closing costs. And the appraisal you can also waive if you think that the appraisal could come in the same as the sales price. I've seen a lot of people nowadays do waive the appraisal so that they can get the deal, they can get into the house, they can buy the house. But typically, most of the times, I wouldn't waive the appraisal either, but that's entirely up to you and the realtor and the seller to negotiate. Like I said, closing costs, you can ask the seller to contribute a certain amount of money toward closing costs, or a percentage toward closing costs. Next slide, please.
Before we go to the next slide, Kim, there's another question. There's another question on the chat.
Okay.
And the question says, does the same qualifying criteria apply when you're building a home? So I guess this will be on a construction loan.
Typically, yes, but we also don't do construction loan here at the U.S. Senate. But most criteria, and I think there was later on in the presentation, I can go over the criteria that the lenders look at to see what you can qualify for.
Perfect. And then there's one more question there, and that is, what level of closing cost is reasonable?
What's the amount? Oh, I would say the rule of thumb for the closing cost that you want to calculate is 3% of the sales price. So assuming in the house, you buy a house at 100,000, I would definitely, leave 3% of that as part of your closing costs for taxes and settlement fee, bank fees, all of those. So it would be around 3,000. So the rule of thumb, I would say on the high side is 3% of the sales price.
Thank you, Kim. That was the last question, so we can proceed.
Okay. Shopping for loans is my next slide. Okay. There are a couple of loans that you can do, you can qualify for. You have 3 types of loan. Next slide, please. You have 3 types of very popular loans. The fixed rate, the hybrid and convertible, and adjustable. I think it's the last one. Can you go back, Milton? I think I don't have this one. Shopping for loans, conventional and government mortgages. Next slide. Okay, well, I guess this is the one. Okay, so conventional loan. I got a little of different pictures, but conventional loan is a private sector loan that is not guaranteed or insured by the U.S. government. So U.S. Senate, most of the time, our loans are considered conventional. And next slide, please. So the conventional loans are the established guideline for conventional loans for credit score, income requirements, and minimum down payment is established, by Fannie and Freddie. And they have two type of conventional loan that we offer, that they have offer, or we have offer, is the conforming loan, which is considered like an average loan amount that Freddie and Fannie Mae had come up with annually. It changes every year for us. And it also has what we call the high price region. And that changes depending on, where we live. For example, in DC, New York, our conforming loan amount could be much higher than if you were in, say, Florida. Because we consider DC area or New York or San Francisco are considered high price area. Non-conforming loan would be anything above conforming. And then sometime that also been called as a jumbo loan as well. And that's like I said on there, the limits are being set by Fannie and Freddie, and it changes every year. Next slide, please. We also have what we call FHA, Federal Housing Authority, FHH loans. This has a guarantee of the Federal Housing Authority. And you can down as low as 3.5%. So I think the information on here should be around 97.5% that you can go up to. Next slide, please. There's VA loans. You can also have, if you are VA, you can get up to 100% financing. You do have funding fees, and you also have what we call the VA certificate. And we do have some VA expert here at the credit union that could do the VA loan for you. Next slide, please. Euro Economic Community Development, we don't do that at the U.S. Senate. And this is only applied for the rural area, which we don't have around here. So, I mean, I can go, I don't know much to say about this type of loan for you, but if anyone needs me to do it, I will research on it and get back to you on this. Next slide, please. State and local offers program with local flexibility of favoring underwriting and repayment term. We, on this type of loans, on this type of program, you have to research on the state and the county you live in. Unfortunately, U.S. Senate does not participate in any of these programs. So if you do want these programs and you research on it, you do have to go with their preferred lenders. Next slide, please. So this is what I have. So then we have these types of mortgages. That we have fixed rate, hybrid, convertible, and adjustable rate. So the fixed rate is what we consider is the most popular type of program where you lock in the interest rate for the life of the loans. So you can go 30 year, 25 years, 20 year, 15 or 10 year fixed rate. So if you, for example, lock in a 30, most popular mortgage fixed rate program is a 30-year loan. If you locked in a 30-year, your monthly payment of mortgage and interest it's not going to change for 30 years. Your total mortgage payment may change because your taxes and your insurance may change on an annual basis. So that total payment may change, but your principal and interest will always stay the same as long as you have that loan outstanding. Okay. The hybrid and convertible, we don't have, adjustable rate. The interest rate fluctuate with the market conditions for the life of the loan. And we have 3 years, a 5 and a 7 year at the U.S. Senate. But you also can find some lender would do a 1 year 3-year, 5-year, 7 years, and a 10-year as well. And what that means adjustable is like if you go with a 7-year adjustable rate, the first 7 years stays fixed. It doesn't change. Your principal and your monthly principal and interest payment stays the same for the 7 years. On the 8th year, the rate will change. And that depends on the lender and depends on your contract and the note that you sign. Sometime it could go, it could change monthly. Typically, it changes 2% per month if the rate does change. And then the life of the loan, it could say, it can't go above 5% of your initial rate. So, for example, if you lock in a 7-year ARM today, and then everything's fine, stay the same for the 7th year, and then on the 8th year, it's going to change, and depends on your contract. If your contract said each year that the rate can change by 2% above the initial rate, and then 5% for the life of the loan. So on the 8th year, so today's rate that when you locked in, say 5%, and then on the 8th year, when the rate changes and then the markets go up higher, that rate could change from 5% to 7%. And then down the road, and then it will do that every year until it reaches the maximum lifetime of the mortgage, lifetime of your contracts, which means that they can't go above 12% in the next 30 years after the 8th year. So 8th year they change, 9th year they change, and it could go a maximum up to 12% for the life of that loan. But you can also refinance if you find most of the time, if you find that the rates is getting too high, then you can always refinance into a fixed rate as well, if you do that. What else do I want to say about the adjustable rate? So it's a 7-year, you could do, it changes annually after the fixed period is over. And then if the rate, for example, if the market was on a downturn, and then on the 8th year, if the rate changes, it could go lower as well for you as well. So it depends on what your needs would be and whether or not you want to do with adjustable rate product. And then the hybrid and convertible is what is considered a lock-in interest rate for a period of time and then converts to adjustable rate for the remainder of the loan. We don't offer that at the U.S. Senate at all. We only have either the fixed rate or the adjustable rate.
Kim, we have 2 more questions here, if you don't mind answering.
Okay.
The first one, it says, how do you decide whether to do a fix versus an ARM mortgage, especially in the current high inflation environment?
It depends because depends on the market. At the high inflation is not, I wouldn't say it's an issue with the high inflation, but it depends on the rate on the market, whether the fixed rate is lower or the adjustable rate is lower. Right now, I would say we are what we call is an inverted curve. So the fixed rate is lower than the adjustable rate. And the last time I ever seen the adjustable rate better would be probably back in the 80s was when I noticed that the rates are better adjustable. But so as far as it's for the last 10 years or so, I would say the fixed rate I've seen the fixed rate is much better than the adjustable rate.
Thank you. The next question, it says, does the United States Senate Federal Credit Union have any type of incentive for members to finance with us at this time?
I would tell you from experience, our rate at the credit union are super low compared to other lenders like brokers or even banks. And right now we do have the promotions of $1,500 we contribute toward the closing costs. So it's really nice to have.
Thank you, Kim. Those were the 2 questions that we had, so we can move to the next.
Okay. Mortgage payments. So what does include in the mortgage payments? You also have what we call the escrow, which is the funds are used for homeowner insurance and property taxes obligations. And then we also have what we call the private mortgage insurance. If you down less than 20%, you do have to pay the private mortgage insurance, and sometimes what we call a PMI. And that varies, depending on the size of the loans and depends on your credit score as well. And then you have the mortgage insurance premium is almost the same thing as the private mortgage insurance, but this is only apply for FHA loans, because you would also have to pay that on a monthly basis as well as your upfront insurance. So those are your type of mortgage payment you have, including your mortgage payment is principal and interest, the escrow amount for taxes and insurance, and private and the PMI. If you have a conventional loan, and if you don't have conventional loan, you would have mortgage payment include principal and interest, the escrow, and the mortgage insurance premium on the FHA. Next slide, please. Compare lenders. So depending on which lender, I think the down payment is pretty standard among lender, because if all the lenders goes by the Fannie or Freddie, they should have the same down payment, options for you. It's either 3%, 3.5%, 5%, up to 20%, or even more, whichever you can afford as a down payment. Discount point would be what we consider a one-time fee that you can use to buy down the rate. So for example, you can have a 5% rate with 0.0 discount point, but you said, okay, well, I want to buy down the rate. So you can pay 1% discount point to get the rate down to say 4.5. So 1% discount point is equivalent to 1% time the loans amount would be your one-time fee that you pay to the bank to buy down your point. Annual percentage, what we call the APR, most people use the APR to compare lenders, because that's including the fees that the lender charged the lender charged for getting the loan converted into a percentage added to your regular mortgage rates. So for example, you have 5% mortgage rate which stay fixed with principal and interest, and then the banks say charge you a $1,300 fees. So the lender has to convert their $1,300 fees into a percentage. So it will bring up the APR from 5% to say 5.15%. But that's how you can compare lender, is by using the APR. But the rate that you have as lock-in for your mortgage will never change, will always be the same. And then I have a lot of people ask me, if their monthly payment is based on the, how did they based on? So it should based on your rate, and the APR is just for disclosing purpose, and it's not, we don't go by the APR to calculate your monthly payment.
Thank you, Kim. There is one more question in the chat.
Okay.
The question says, what is the current interest rate that the USSFCU it's offering for its members, and any options for the members that they want to refinance in 2 years after purchase?
Yes, we do. Your rate, depending on your credit score, depending on what program you are choosing. And then, you can find our rate on the website as well for the mortgages. You can always refinance. So if you buy a house, and then if you buy a house today that say 5%, and maybe 2 years the rate changes to be lower, say 3%, you can refinance that house with us with no problem.
Thank you, Kim. And one more question here, and this is actually, it's a great question. It's what is the difference between the mortgage products that we offer here at the credit union versus the other mortgage lenders? Should you just look for the best rate?
You want to look for, I think I'm if you ask me, I would say look for the best people or the best mortgage loan officers that is response to you, is responsive to you. So, I mean, you can call the rate, you can compare the rate, obviously, you want the cheapest rate because we all want the cheapest rate. But at the same time, you want to be able to talk to that mortgage lender anytime you need to talk to them. So I would say both the rate and the responsiveness of the lender. Will they be there to help you go through this process? Will they be able to answer any of your questions? Were they able to get the loan through for you? Were they be able to talk to your realtor? And all that stuff. So it's how to choose a lender. I would definitely choose not only the rate, but how the customer service is to you.
Now, with that being said, what would you say that sets something that what would you say that sets us apart from the other companies?
We are very responsive to our members, and we are very accommodated to our lenders. I mean, to our members. We are. I can tell you that we have a very lucrative, lock rate ability. We allow you to have a one-time float down, which most lender won't let you once you lock it in. We also, if you do a builder on the house, you can also, we allow you to extend rate without fees. So it is very lucrative. We are very accommodating to our members.
Thank you, Kim.
Okay. Next slide, please. Do you know the criteria lenders use to determine the eligibility of the mortgage loan? There are 4 items that we look for: stability of income, adequacy of income, sufficient money to close, credit worthiness. So depending on your credit score, we look for credit score. If you minimum credit score, I believe these days we look for is 620 for FHA and 680 for conventional loan. You definitely have to show as proof that you have sufficient money to close. So if you have, you have to show, I mean, we will check on that like maybe 2 weeks before closing. We have to make sure that you have enough money for close. And of course your income is there. And then stability of income, as long as you in a job for more than 2 years, we consider stable. Next slide, please. Credit report. I mean, credit score and credit report are very important in determining your rate. I want to tell you that you can also check on your credit bureau report free for every year from all 3 agencies, which is the Equifax, the TransUnion, and Experience. Next slide, please. And this is how your credit score comes up. And a lot of people said to me, I get my score at this amount, and I got the score at say 800. How come you use 750? And for the mortgage, we pull credit bureau. I mean, we pull credit report from all 3 bureaus, and we use the middle score to determine your rate and qualifications. And this is the credit score. This is how they make up your score. It's 35% month payment history, 25% credit utilizations, 15% of the credit history, length of credit history, and 15% new credit, 10% types of credit use. I would recommend you don't pull your credit often because that's affects your credit scores. But if you do have to pull for, like, if you go shopping for a mortgage rate and you pull within 30 days, your score should be the same. It should be not affecting as much at all. Okay. Next slide, please. The closing. What's in closing? Their closing, you'll be, once you put in a house, you put in an application, you got a house, you put in applications, closing time comes is within 30 days. So you would have, you will get, as a lender, we send out the closing disclosure 3 days ahead of time for you to review. We send that also, we also send that a copy to the settlement company so that we can match up, make sure that everything is completely correct. And then, you know, we can, there has to be match up on the closing disclosures for the final number. And then if you have any questions, then you can either ask, you know, the lender, or you can ask your title company. Next slide, please. Closing tip, read all the documents before signing, take your time. I would say yes, read all the documentations where the settlement company, the settlement attorney asks you to sign on a dotted line, but the two important documents that I find that is very important to me, and a lot of attorney, you know, had mentioned before, it's the note, the promissory note, and your deed of trust. Make sure the name is correct, the address is correct, on the note, make sure the term is correct, and all of that stuff. Those are the most two important items that I would look closely. But yes, do read all of them before you sign. Be courageous. Don't let the closing agent intimidate or rush you. And you know, don't hesitate to ask questions if you have any questions. Sometimes I get calls during the closing session as well. So, but it's very rare, but the closing attorney should be able to answer all the questions for you. Next slide, please.
Kim, before we go to the next slide, we have one more question there for you. And the question, it's in regards to you were talking about the 2-year of employment history that we look for. And we want to know how strict is that? So if you've been in a job for, let's say, 1.5 years, but your previous job was very similar, both in the same industry and income-wise, is that a satisfactory history?
Yes, I'm sorry. I will take that. I will clarify that. As long as you're in a job in the same line of work for 2 years or more, you should be fine. We understand that you change employment, you change workplace for better. Then as long as you're in the same line of work for minimum of 2 years or more, then you should be fine.
Thank you.
Next slide, please. I know I'm almost time too. I'm almost out of time as well. Helpful reminders. You know, you, like it's on here, it said chat with your previous homeowners. Next slide. You do want to review your home inspections. Sometimes I get a contract on a home, and then home inspection comes in and there's something's wrong with the home, and then you can cancel the contract. So do get the home inspections. Like I said before, I would not waive the home inspections, especially, you know, if it's not a brand new home, I would definitely do a home inspections report. Okay. And next slide, please.
Before we go to the next slide, we have one more question here in the chat, Kim, and that is, does USSFCU service the loan, or will it be transferred to a different lender once it's closed?
Right now, we reserve the right to sell it later on, but right now we hold our loan and we hold our loans as long as it's conventional loans. We do have to sell off the FHA and the VA or investment loans. We have to sell off, but we do all of those loans, but we just don't hold that in-house. We just, you know, we only hold anything that is conventional, 90% or less. As long as you have a primary home, as long as it's primary home and secondary home, we will hold. And we do service our loan.
Thank you.
Okay, so remember to save some money for maintenance, which is the reserve that we talked about, because you want to do, you know, some home improvement, furnish your house, and some maintenance around the house as well. Okay, next please. And remember to always have sufficient homeowner insurance. In terms of homeowner insurance, you always want to, when you shop for homeowner insurance, you always want to tell them that you want to have 100% replacement value of your home. So, and then the agent will know what that means, and they should be able to quote you, to give you a quote based on that. Next slide, please. And that's That's the end of my presentations. And if you do have additional questions, if you want to shoot me an email, those are my contact information. I also have another colleague. His name is Jeremy Hill, and he also will be able to answer any question you may have as well. And you can also see we have a $1,500 toward closing costs through the end of June. Next slide, please.
Awesome. Thank you, Kim. Before we go to the next slide, I do want to ask you another question that we have here in the chat.
Okay.
And the question says, is there a formula, I'm sorry, for deciding whether to continue to rent might be cheaper than buying a home?
I don't have a formula in any sense, but if you, I believe there should be on our website, should be rent versus home buying. And then you could, I think there is one, I don't have it readily, but I'm pretty sure we have something like that on the web. But if you
Awesome.
if you want me to do it, I can easily do it for you as well. I can run some numbers. I can run the number for you, assuming that you know, the type of the house you want to buy and the range you want to buy. I could run those numbers for you, and we can compare.
Awesome. Thank you, Kim.
You're welcome. Next, please. Next slide. Okay, so beside me being able to catch me on the emails and on the phone, I also be at the Hart branch every Thursdays, and then my colleague Jeremy Hill is at the Bowman branch every Tuesday if you want to meet us face to face. Okay. And then we also are doing conversations and cocktails on April the 26th from 6 to 8 on at the Credit Union House. And you are all welcome to come. You just have to RSVP. You are welcome to come to meet all of us, our home loan dream team, myself. There's Sharon, she is our home equity expert, and Jeremy, and then Phil is our real estate expert that we have at the event. And that's the end of my presentation, and I hope you enjoy it. And if you have any other questions, please do not hesitate to email me, call me, or come and see me at the Hart, or come and see us at the event, the Conversation and Cocktails event.
Thank you, Kim. Again, that was a very exciting and again, I always say this, and I probably members are going to get tired of me saying this, but I feel like every Wednesday we always have really interesting webinars that we're providing to our members, and this one it definitely on the top of the list, especially as we say at the beginning of this presentation that the weather is getting warmer. It is spring season, and I know that that's the time when oftentimes people like to go in the market to buy houses or refinances perhaps. And again, I just want to let you all know that that the team that we have here at the credit union, it's an excellent team. They have so many years of combined experience between Jeremy and Kim. It's a little over 30 years, believe it or not. So these two individuals, they know all the ins and out, and they really have a lot of great resources and things that we can help you achieve your your dream of becoming a homeowner, or perhaps looking and see what other options we can provide for you for those that are already homeowners. So Kim, thank you so much. But before I let you go, I do have one more question here that's being asked, and that is, do we offer any resource for first-time home buyer programs in the area? If this person is interested in Montgomery County in particular. Thank you.
Are you referring to assistance in terms of down payment help, or what are you looking exactly for?
It says that it's for any resources. Yes, my guess would be any. Do we have any assistance for first-time home buyers? Correct. So like either closing costs or down payment.
Well, we do have the $1,500 closing costs right now, but other than that, we don't participate in any other kinds of down payment helps or closing costs help at all.
Thank you, Kim.
You're welcome.
I had another question that somebody sent me directly, Kim, and it was regarding how you you advise to contact the previous owners of the home that you're trying to purchase. This person in particular was telling me, anonymously, that they saw a post or an ad regarding a home that they were interested in. But on the description, it would say it's strictly prohibited to contact the previous owners. Is that a law, or can you surpass that requirement if it's on the description based on your experience?
I can't say it's a law, but I mean, if the seller doesn't want to be, doesn't want to talk to a potential buyer, then you probably won't be able to do that. But definitely, if it's not on the listing, if you know somebody it's about to sell their house, I would get a real estate agent to go in and contact the seller. And as a buyer, you don't pay the real estate agent any kind of fees. So I just want to clarify that. The sellers is the one that paid the real estate agent. You as a buyer, you can find a buyer agent to represent you so that you can negotiate, to purchase a house, but you do not pay their fees to the agent. It's the seller end up paying the fees to the agent. I hope that helps.
Definitely. That's great information. That's good to know. And, with this series, I'm sure that everybody learned something new. We have so many comments on the Q&A. Everybody's saying great presentation. So they're giving you kudos, Kim. And also I wanted to give a shout out to Jeremy, our other mortgage expert. He's here, part of the attendees of the webinar. So Jeremy, thank you for your support. And we're looking forward for, our members to meet you as well. And I believe we have one more question, correct, Milton?
Yes, Eddie, thank you so much. There is one more question. The question says, Kim, could someone get a personal loan for a down payment to purchase a home?
Okay, so that's a tricky question. The answer is no. If I go and ask the underwriter that, they will say, no, you cannot. But if you ask me, I would say, if you anticipate that you're going to do that, then you need to do it ahead of time. And then not like right before you're going to buy a house. You have to do that ahead of time.
And if you don't mind me adding to, this is something that we shared in one of our previous presentations. I believe it was around the, I can't recall which webinar it was, Carrie, but I know I believe it was around the fraud and identity theft. That one of the advice that we want to give to all of our members is that if you know that you're going to be in the market of buying a house, is that you prepare yourself at least 6 months in advance, so that way you start reviewing your credit, make sure there's nothing funky in there, and if so, you can dispute anything that it doesn't belong on your credit report, and also, I mean, like you say, Kim, again, not that we want to encourage that, but if you think that you might need additional funds for a closing cost, perhaps that could be an opportunity to do that with plenty of time, so that when it's time to get into submitting the offers and having the funding available, you have that all in line, and it's been sitting in your account for at least 2 months. Something that I would recommend. So thank you so much, Kim, for answering all of your questions. Eddie, Carrie?
I do have one more question, actually, that somebody else sent me. And this is, I guess, a myth that they have heard on the streets, or, word of mouth. But Kim, when somebody purchases a home, do they automatically have equity on that home? Is that true or not?
No, the equity depends on how much you put down. It's your equity. And then it's not automatic. It's the money that you put down, and at the same time is the market appreciation, depending how long you keep the house. As long as the market appreciates and stuff, then you should be able to, that would be considered your equity. So your equity would be your down payment, and then how long you stay in the house and the market appreciation of the house is considered your equity.
Perfect. Thank you very much. I feel like the Mythbusters, we're busting myths over here. So Kim, thank you for doing that.
It's nothing automatic. You have to put some sweat into it.
Definitely. Like somebody told me once, there's no free lunch in America. So that's one of the great examples,
You got to put at least 3% down. So any other questions for me?
Do you have anything on your end?
Carrie, you have anything?
No, but I will go ahead and share the slides in an email to follow up. We also have some resources as far as like calculators and checklists on our website. I'll link to those, and then thank you, everybody.
Thank you, Carrie. Yeah, and just kind of piggyback to what you said. Make sure that you use the resources that we have here at the credit union. I think one of those actually it's that it's one in regards to you guys are able to get your FICO score for free, and there's a tool that we have available that you can actually plug in numbers to show what kind of an impact your credit will have if you do decide to go with a mortgage loan. And that's something that I highly encourage everyone to do. And also, if your credit is not just there yet, remember for FHA loans you have to be at least 620. For conventional loans, we're looking for a 680. So you can definitely play with the numbers and see what it is that you need to do in order to reach the credit score for the particular product that you would like to pursue. So again, definitely utilize all of the resources that we have. And as Kim stated early, we welcome you to visit them. Kim, it's at the Heart office every Tuesday, and Jeremy over at Bowman every Thursday. But most important, this conversation and cocktail that we're gonna have next week, it's free for all of our members. You just got to RSVP, so we're gonna send you the link for you to register if that's something that you would like to attend. It will be an exciting event. It's from 6 to 8 p.m. There will be a lot of surprises for everyone that attend. So again, we just want to invite you all to take part of this amazing event. And with that, also invite you all to our next webinar for next week. It's going to be another exciting one. Or my colleagues from marketing will be sending the information for you all later on in the week. But again, just want to take this time and say thank you for joining us. Thank you to our amazing panelists as always. You guys are amazing, and we look forward to having you back in another webinar soon. You'll have a great evening now.
Oh, Milton, before you go, can I just say something? I'm at the Heart on Thursday, and Jeremy's at the Bowman on Tuesdays.
Yes, my apologies. I had it backwards. Thank you so much for correcting me on that one. My apologies.
Thank you.
Thank you, everybody. We appreciate each one of you that attended this webinar this evening. Personally, I learned so much. So Milton, thank you for being, like you said at the beginning, the MC of the night. Kim, great presentation. We appreciate you. And Carrie, as always, content queen. So thank you very much for everything.
I thank you both, all of you.
Thank you all. Have a good evening.
Bye-bye.
Bye-bye.